person, go ahead and continue eating your snack. So this is a lunch meeting, and so those who have joined in person, we do have light refreshments for those um, individuals. And so today, we would like to welcome everyone to learn more and how to get access to capital. We have a guest speaker here. His name is Aaron Palmer. We will introduce him in a little bit. So, but before we do, my name is Don Pint. I'm a business navigator with the United Cambodian Community, and we will be presenting the Access to Capital Workshop with Wells Fargo Bank. And we have our partner, Sayon. If you would like to introduce yourself, and then I can go more into our disclaimer.
Okay. Hi, everyone. Welcome, Aaron, to our webinar. I'm really happy that you're here to share with us about the access to capital, finding funding and support for our small business is really important way to get started as a resource. Yeah, so I'm really happy to hear and looking forward to what you have to share.
Thank you. I'm looking forward to it as well.
All right. So like I said, I just need a quick read a quick disclaimer with our workshop today. Basically, UCC, or United Cambodian Community, we're a collaborative partner of the Asian Pacific Islander Small Business Collaborative. We provide services on an equal opportunity basis, providing reasonable accommodations to individuals with disabilities and communicating with people who have limited speaking proficiency, if you request it at least 2 weeks in advance. We are partly funded by the Small Business Administration. And so our opinions or recommendations that are made today are just those of the presenters and not necessarily the Small Business Administration. And so with that being said, I would like Aaron to introduce himself, and you can, from there, you can dive in.
All right. Well, thank you, Don. I appreciate that. And I appreciate everyone who came today. Looking forward to presenting and getting to know all of you throughout the webinar. So my name is Aaron Palmer. I've been with Wells Fargo for a little over a decade. That entire time has been here in this great city of Long Beach, California. I've been in various roles with the bank over the past 10 years. I worked in our community bank, so fancy word for working in our local branches. I started out doing that. I've worked in our wealth and investment management segment in downtown Long Beach as a trust administrator, also referred to as a trust officer, working with wealthy families who are passing assets down to their future generations. In the past few years or so, I've been working for a business banking segment, working with small business owners, predominantly here in the Long Beach area, but also in some of the surrounding cities as well. But Long Beach has been my main focus pretty much for the past decade in working with small business owners. I've also been involved with the UCC in the past. I presented at this same event, I think probably 4 or 5 years ago, so I'm happy to be back. One more thing before we dive into the access to capital presentation. I'm involved in a couple of organizations in the Long Beach area. I invite you to join and see how you'd like to get involved if you have any spare time. These are great organizations for business owners to know of. I'm part of the Long Beach Chamber of Commerce's Young Professionals group. So if you are a young professional, and we have no upper limit to who is considered a young professional, and you want to get involved in a great networking group, the Long Beach Chamber of Commerce is a great place to do that. It's a great way to build your business up. And we'll talk about why that's important in the context of accessing capital later. And also I'm part of the Downtown Long Beach Alliance, which is an organization in downtown Long Beach, which does many different things, but one of them is working with small business owners in the downtown area as well. So 2 organizations I wanted to mention, they do relate to accessing capital, as you can rely on these organizations to help possibly grow your business. So anyway, with that out of the way,
Aaron, one last thing. Can I just mention something before we start?
Absolutely.
Yeah. So I just want our online guests to know that if you did have a question, there are a Q&A button, and you can also type your questions in the chat, and we can respond to you accordingly. And also, we would like to know, for those who are joining online, if you can let us know, what type of business that you're currently running, or what industry you're in, or maybe what type of business you're looking to open up for yourselves if you're in that startup stage. So yeah, with that being said, if you need to take a quick bio break, feel free. We have that down the hall for those who are in person, and then for those online, feel free to take up any bio breaks if you need to, because this presentation will run for about an hour. Okay, go ahead, Aaron.
Well, my understanding is that it will also be on YouTube as well, right, Don? So they can see replays later if needed. So
That's correct. So afterwards, we will upload this onto our United Cambodia Community YouTube channel for those who want to get access to this later.
all right. Well, thank you. And so, yeah, my understanding is that those tuning in, whether you're here now in person or on the web, or you're watching this on YouTube at a later date, is you want to get an understanding of different ways to access capital out in the marketplace. I'm assuming, going into this presentation, I'm just going to start at the ground level, and we're going to work our way up. This is not going to be an all-inclusive way. It's not going to go over all of the different ways that you can access capital, but it is going to go over some of the main types of capital, and what these different capital sources are, what their purposes are, why they might be good or bad, so on and so forth. So it's to give you a general understanding of your options out there, so that you can hopefully make the best decision for yourself. Hopefully Don can also put my email, somewhere on the YouTube, channel, or so people can contact me if they have any follow-up questions. I'd be happy to answer any questions people might have, after this webinar. Always available for that. So, okay, so we'll dive right in, going over some of the different types of capital sources. And the first few capital sources that I'm going to speak about are not traditional capital sources. So, as Don mentioned, and as I said in my introduction, I work for Wells Fargo Bank. So it's a traditional, bank, it's a traditional lender. Chase, Bank of America, all these big banks you see driving through, downtown Long Beach, these are traditional lenders. We're going to go over, some traditional lending products at the end, but in the beginning here, we're going to go over the non-traditional lending sources, to help you guys get creative, help you find ways to access capital when the traditional sources maybe aren't an option at first. So, number one, micro lenders. I know micro lenders have been involved with the UCC in the past. When I presented here 4 or 5 years ago, there were a handful of micro lenders who came. You don't need to access them through the UCC. I'm sure that Don here would be happy to point you in a good direction if you need some help navigating that process. But I'm also going to give you some tips here to help you find micro lenders that might be able to help you in the future. So what is a micro lender? Let's start with that. A micro lender is a lender that extends credit to borrowers who typically can't qualify through a traditional lender. So like I was saying, like a Wells Fargo, a Bank of America, whatever, Chase. They exist there to make loans to people who can't qualify for traditional sources, or maybe they don't want to go through a traditional source. Maybe the micro lender offers terms that are better for that recipient of capital. So, for example, if you own a business that, maybe doesn't have the most reliable income because maybe you just started the business, maybe you've had a choppy year, maybe something just happened where the entire economy was shut down for 3 years and you weren't able to operate your business, called COVID-19. So if anybody remembers COVID-19, it was pretty hard for small business owners to operate their businesses, and it messed with a lot of businesses' financials. So looking back the past 2 or 3 or 4 years, a lot of business owners, they might have a great product or service, but if you look at the tax returns, maybe the financials don't look the best because something out of their control happened to everybody, and it hurts the financials. So maybe that there's not a good track record of income for whatever the reason might be, and that's okay. That's just part of reality, and that happened to everybody. Maybe the business or the owner of the business doesn't have a verifiable credit history. Maybe they've never had a credit card before. Maybe they've never had anything that reported to the credit bureaus. And therefore, a traditional lender, when they look at this potential borrower, they say, well, looking at a credit report here, we don't see any record of you making payments on time. We don't know how you manage credit. So we might not be comfortable to extend a loan or a line in this situation. So micro lenders also, solve that problem or issue in some cases. Maybe the type of loan that the borrower is looking for generally requires collateral. Putting something up as recourse in the event the loan is not paid. Maybe a traditional lender would say, no, we require collateral for this type of loan. A micro lender might not require that in whatever instance the person's seeking capital for. So what's the purposes of a micro lender? Well, micro lenders they exist for many different purposes. It's not just for business purposes. There are micro lenders who make loans to individuals for non-business purposes. But most of them, and for the context of this conversation, micro lenders do help solve a problem in the small business community. People that are looking to start or grow their small business might go to a micro lender, or someone who does not currently own a business. Maybe they're looking to become self-employed and they need a little bit of capital to get started. And they can't qualify through traditional lending sources. In those cases, a micro lender might be the right choice for them. Wells Fargo on its website does have a resource on micro lenders. And what I will do here, let me pull up the page. I want to share it with everybody. I'm going to share my screen here. Okay, can everybody see my screen, and can they see that it says microloans, what you need to know? Okay.
Yes.
Okay, great. Yeah, Don, you gave a thumbs up. Okay, wonderful. Okay, wonderful. So this is the Wells Fargo resource on microlenders. It's on smallbusinessresources.wf or wellsfargo.com. You can go there, type in microloans, and you will have a nice resource here for you. Just in a nutshell on this page, there is a tool here that you can click on, and it will take you to the SBA website, and it will help recommend microlenders to you. So, I mean, there are lots of microlenders out there. Just like with anything, some people offering a service or a product, they might not be the best choice. Maybe some of them aren't the most honest people. Well, how do we filter through all of that and find one that has been vetted? Go to the SBA website. They will help you find a reputable microlender, or at least they'll point you in a direction for a microlender in your area. Keep in mind, some microlenders will only lend in certain areas or to certain businesses, or to certain businesses that serve certain needs that aren't being met by enough businesses. So use this tool. It will help you out. And that is that. So I'm going to stop sharing my screen again. We'll come back to that later. All right. Can everybody not see my screen now? You say nobody sees the screen anymore?
We're good. You can continue.
Okay, thank you. Okay, so microlenders offered by the SBA, there's the resource. I would recommend looking there if you are looking for a microlender. Another couple notes that I want to make on microlenders: they generally offer flexible terms, not always. And I'm not going to to generalize, but a lot of them offer very flexible terms. Most traditional lenders will not. They will want to look at your tax returns. So they're going to look at your past financial history, what you reported on your tax returns in the past. Look at your financial statements, like your income statements or your balance sheet, showing your performance up to a certain date. Micro lenders, some of them might look at financial projections. So they're a little bit more lenient. They might say, okay, show us what you think you'll make in the future. Tell us why you need the money. They're looking for, in many cases, businesses that have good plans, good business plans. They can show why, they can back up why they think they're going to be making a certain amount of money. So again, a little bit easier to get capital in many cases. And microloans also can be used for inventory. You need inventory to sell. through your business, working capital. You can use it, pay employees or whatever the case might be, advertising, machinery, equipment. Lots of businesses need equipment, right, to produce their product, and many other things. But those are just some of the most common uses of a microloan. All right, so those are micro lenders in a nutshell. If anyone has any questions, by the way, throughout this, feel free to, there's a question and answer tool in Zoom, so feel free to use that. Or you can just blurt out. It's fine too. Just say you have a question. Or at the end, I'm also going to open it up for questions as well. So if you're taking notes, or if you're someone on YouTube who is watching this in 2035 and you want to reach me, my email should be there, and you can reach me there. Okay, so
Aaron, just a quick question. It might sound a little bit wonky, but as far as like microloan, I guess places like pawn shops and things like that are not considered micro loan, right? That's something else because it's
something else. Yeah, I mean those are typically usurious lenders. They usually make loans on very bad terms, and generally you want to stay away from pawn shop type lenders.
Mm-hmm.
I would not put pawn. I mean, they typically are making loans less than 50,000, which is generally the range of what is considered a micro loan. But I wouldn't put them in the category of a micro lender because generally micro lenders are, at least the ones recommended through the SBA website, generally they're trying to help businesses on a mission, people to solve problems, to help the community with its economic development. Pawn shop lenders, maybe some of them have good hearts, but generally I wouldn't recommend someone go to a pawn shop lender, and I would keep them out of that category. Maybe with like payday lenders, another lending source that I'm not speaking on behalf of anyone, but in many cases, they charge very high interest rates and things of that nature. So I would start with that SBA tool to help you filter through all the lenders that make loans in that 0 to 50,000 space, help you make the best decision for yourself. But you're also going to want to look, do some vetting on your own, make sure, look at reviews, make sure they have good ratings and people have had good experience on those websites. But to answer your question precisely, I would not put pawn shop lenders in the category of micro lenders.
Yeah, right. Thank you for pointing that out. I know sometimes our community may think that that's a quick fix, but then you have to look at the long term of your business, right? In terms of you want to be able to sustain this, but what kind of legitimacy and perhaps predatory area, some of these easy lending places that would do harm to you versus supporting you through the microloan through an SBA.
Absolutely. And later on in the webinar, I'm going to go through some cold hard truths about borrowing money and some things to look out for, because in some cases, borrowing money can make sense if you're the right person or the right business with the right background, the right goals, the right financials. But in a lot of cases, and honest lenders and providers of capital will tell you that taking out a loan doesn't make sense for everybody. And in a lot of cases, it's not the right thing to do. So we'll talk about that, and then we'll talk about ways when it does make sense to take out a loan, or when it can make sense, and when it can potentially help you. But it doesn't always make sense for everybody. We'll go through those cold hard truths a little bit later. All right, so grants. So actually on that topic, grants. This is a way to access capital that does not involve repaying anybody. It does not involve paying any interest or any sort of fees normally. So let's talk about grants as a way to access capital, and it should be on the top of any small business owner's list, especially if they're starting with very little and they want the lowest amount of risk when accessing capital. We'll talk about some of the pros and cons to that. So, what are grants? You may or may not know, but a grant is basically, and this is a very simple explanation of what a grant is. I'm just going to go ahead and say this. You can think of it almost as, quote unquote, free money. Okay. It's not really free money. Okay. But it's just one way to look at it is free money provided by an organization to support some sort of cause or need. And I say it's free money because generally you don't have to pay anything back or pay any fees. Given, you don't have to pay grants back, competition for them is pretty stiff. I mean, everyone wants free money. Everyone wants something when they don't have to give anything back. But with that being said, I mean, you get a grant. It's not like you're giving nothing back. And the reason why I say that is because generally grants are only given, by, to certain businesses that are solving certain problems. So that business that's getting a grant, they're probably doing something for the community that's helping people out. And the grant, the organization that's giving the grant sees in that business that they are helping the community. They're doing something that, maybe not enough businesses or organizations are doing. So they're giving the grant to help the economy in most cases. So where can you find a grant? Federal and local governments are great places to start looking. There are also charities and private foundations out there that will provide grants to businesses in certain regions, catering to certain causes. So a lot of different organizations out there and municipalities that will provide grants for many different things. How can you increase getting a grant? The competition is pretty stiff. So what can you do to increase your chances? You can look into learning about grant writing, figuring out how to, you're pitching these organizations. You're telling them why you deserve the grant over the other 5, 10, 100 other people asking them for the grant. What makes you the right recipient of the funds? So you can read some books on grant writing, you can watch some YouTube videos, a lot of free to almost free resources out there that will go through those with you. Now, maybe writing is not your expertise. Maybe, maybe you're good at math. Maybe you're not as good at writing. And everyone has their own skill sets out there, right? So there are also, grant writers that you can typically hire, generally on a contingency. So this is where I say it's not free money. Sometimes you do need to pay someone to help you write the grant proposal, and generally they'll take a percentage of the grant if you get it. In some cases that can make sense, but check with the organization that's giving the grant. Maybe it's not even. Maybe you don't even really need it. Maybe that organization likes what you're doing so much, and there are so few people doing what you're doing or aiming to do that you don't need to hire someone to help you write the grant. Maybe you can read a book on grant writing, watch the YouTube videos, whatever the case may be, and submit it and see how it goes. Up to you. You're gonna have to decide whether it makes sense, how big and pressing your need is, to decide whether or not to hire a grant writer. Those are two things I'd point out. You want to at least know how to propose a grant from an organization. You want to make the strongest case possible because competition is stiff. Also, last note on grants, some grants might come with strings attached. So again, when I said it's free money, quote unquote, okay, maybe they're giving it to you and you don't have to pay anything back. There still might be some strings attached. So it's nothing in life is really free, right? Everything comes at a cost. So you want to make sure you know what you're signing, for before you accept money from anybody. Generally, they're going to want you to do something. So make sure you're comfortable with that. Hopefully, it's just they want you to do what your purpose in life is. Maybe whatever your purpose is. Hopefully, they're saying we like what you're doing. We want you to keep doing that. Great. Okay, wonderful. But if there are things there that you're not comfortable with, don't do it, obviously. But to know that, you need to read through what you're signing, right? So make sure you read through that and you know what you're getting yourself into before you accept money from anybody else. Okay, third option here is, you say access to capital event. What I'm going to say, some people might say, why would you even say this? We're coming to you to figure out how to access capital in the marketplace. But many businesses have done this, and this might be the best place to start for many small businesses. Okay, it's the hardest way to access capital, and that's because it's your own capital. Okay, so it's called bootstrapping or self-funding. So what is bootstrapping or self-funding? Well, it might be self-explanatory, but it's the process of funding your business with your cold, hard cash. You've worked for it. It might not be what you want to hear, but many businesses have started without the use of credit, without the use of grants. Again, I know that we're here to figure out how to access capital, but something I do want to put out there. We'll go through the pros and cons of that so you can think about it yourself. And, pretty much any time you're accessing capital, there's going to be a mix between whatever choice you choose, whether it's a microloan, a grant, a traditional loan, and a little bit of bootstrapping. So let's just talk about that, because it's going to be probably a part of any mix you choose anyway. So you don't have to pay anything back. That's the number one benefit. You don't have to pay anything back when you bootstrap or self-fund. There's less risk. You don't have to rely on lenders or feel the pressure of making loan payments. You don't have to ask family or friends for investments, which could sour your relationship with them. The cons to it, and think really long and hard about these cons. Are they really so bad? It can take longer to get started. You don't have as much leverage, so if things go well, you might not be able to benefit from leverage. But in many cases, and we'll talk about this a little bit later, but many businesses down the line, they regret taking out loans. And we'll talk about a little bit more about why that's the case later. But the less credit you use, especially when starting a new business that you have no experience in, right? If we're talking about people in that category, you're probably going to want to bootstrap as much as possible because, and we'll talk about this a little bit later. We'll go over some of the statistics about business failure rates, what you can do to lower your business failure rate, things of that nature. But the more you can self-fund, the less risk. And it's generally once you have some, a few years of, right? I'm talking to brand new business owners. Generally, after a few years, you have some experience, you have some clientele, you have your processes and systems in place. You know exactly what to do to generate cash out of thin air. You start with nothing, and you've built processes. You know how to get from nothing to some cash that goes in your pocket. It takes a few years of experience. Then you're in a better position you're in a safer position to borrow, right? Because less likely of failure. Okay, so self-funding bootstrapping. Maybe that's the most annoying point I'll make today. But I did want to put that out there because it is important for people to do that as much as possible in many cases. Okay, another source of capital, family and friends. Okay, this is perhaps one of the most popular ways that new business owners get access to capital to start their companies, to buy equipment, to expand, to start a location. Okay, this does not involve going to a lender. It does not involve using your own money. Self-explanatory, but again, many business owners have started out with seed investments or some money from family and friends. Pros, very reliable terms. They're going to be a very friendly lender, source of capital. In some instances, you might not have to pay back the funds. Okay, cons, it can ruin relationships, especially if they expected the money to come back and you don't pay them back. It can be uncomfortable asking family and friends for money. There could be a stigma depending on the culture you're in. Every culture is a little bit different, but there could be a stigma associated with asking. And also, a lot of business owners have a desire to self-fund or to not ask family or friends because they don't feel comfortable asking. As simple as that. Okay, crowdsourcing. This is a somewhat of a newer way to access capital with the growth of the internet and technology getting better and better over the past few years. Crowdsourcing has become a lot more common. So what is crowdsourcing? It's a way to source capital from many different sources, usually via the internet. Pretty much all of the major companies that facilitate crowdsourcing are on the internet for a certain project, business need. Sometimes when you crowdsource, the money is given to you as a gift. Usually a lot of charities use crowdsourcing to raise funds for whatever the cause may be, maybe a church or a temple or whatever. They have someone in their community or someone who came to them, and they'll make a page for them to raise capital for them to give them money. But businesses also use crowdsourcing services to help them raise money. It can help if you have like a well put together video or pitch the community. Why should they be giving you money? Are they giving it to you as a gift? Are you going to repay them? Are they buying into your company? Are they going to become partial owners in your business? You have to explain how the money is going to be used. In many cases, you can make the terms of the crowdsourcing agreement. Some of the sites will do it for you, depending on which site you go on. But at the end of the day, people need to want to give you the money. So generally, they're going to want to be paid back with some interest. They're going to want some ownership in your company. If you have a company that serves an unmet need and it's either a 501c3 or a charitable organization, or maybe it's not, but it's still meeting some unmet need, maybe people will want to give you the funds as a gift. If it will help their community and maybe in some way come back to help them or those around them that they love. So you need to, in your situation, you'll know what the terms of the crowdsourcing deal should be. But again, generally either it's a gift, no strings attached, just here's the money, love what you're doing. There you go. It's a loan, you're paying it back to many different people, and the site will typically facilitate the repayment to the people who gave you the money in the first place, or they're buying an interest in your business. That can get complicated really quickly, though. I mean, if you're giving lots of people interest in your business, so generally they're loans, but every site and every deal can be structured the way you aim to have it structured, or you just don't get into it in the first place, right? Okay. So now that we've gone over a few of the most common non-traditional ways to raise capital, let's talk about some cold hard truths that everyone who's seeking capital should be aware of. This is not to discourage anybody from seeking capital. It's to tell you that the realities of the situation. And also, there are situations when it does make sense to raise capital. So let's talk about when it can make the most sense to go and seek capital from other people, and when maybe you should reconsider. And wait until you're meeting the you have the foundation that we're going to talk about here and help you avoid some of these dangerous pitfalls that lots of business owners fall into and later say, oh man, I wish I hadn't done that. That really caused a lot of stress and headache for me, and I wish I'd never taken out that loan. So any responsible lender should tell you this. And there are lots of business gurus on the internet. I won't say any names who tout the benefits of using OPM, other people's money. Let's borrow some money, let's start this business, it will go up 5, 10, 15x, we'll pay it back and we'll pocket the difference, it'll be great. I saw people see videos on TikTok of people borrowing money, flipping things and paying it back. That can be a very dangerous proposition. The truth is that the vast majority of businesses will fail. That's just the statistic. That's just the math. Statistics have proven that over long periods of time. The government collecting data and seeing who's succeeding and who's failing. More than 50% of all businesses. This is not to say your business will fail, but more than 50% of all businesses will fail within 10 years, and in about 5 years, about 1 in 2 businesses will fail. A lot of those businesses take out loans, and then they end up having to pay it back out of their own personal funds after the business goes out. So the question is it actually smart to borrow money to start a business? Is it actually smart to borrow money to operate a business? Is it actually smart to borrow money for any need? Well, I make a living, in part, a lot of what I do is I lend money to businesses. I wouldn't be doing this if I thought it was bad for everybody. It's not bad for anybody. It's kind of like a Neanderthalic way of looking at it. It's not so black and white. The answer is it depends. Some questions that you want to ask yourself before you sign a loan agreement. You want to ask yourself, so if this business fails, can I repay the money using my personal income? Again, the statistics are not on the average person's side. I'm talking about averages here. Everybody's different. Some people will start businesses and they'll come very wealthy. Some people will start businesses and they'll have average outcomes. Some people will start businesses and they'll fail. We talked about, looking at lots of numbers, the big picture, what will happen. That doesn't mean will happen to you. So do you have the income to repay the loan or agreement should the business fail? Almost every lender out there today requires something called a personal guarantee. I've talked to a lot of business owners out there, lots of prospective borrowers, and they come to me or they come to people I know, and they say, they ask, are you guys going to require a personal guarantee? Hey, I'm not going to have to repay this, right? Because I have an LLC or I have a corporation. So if anything happens, I'm not responsible. Well, the reality is actually in pretty much every case you are. Most lenders out there will require a personal guarantee, which means that although the business is taking out the loan and the loan is being given to the business, what the lender is going to do to protect themselves, knowing that so many businesses ultimately fail, they're going to say, okay, we'll make the loan to the business. But with that being said, if anything happens to this business, you are going to be responsible to pay it out of your own personal income. And you're signing this so that way we can get past the LLC or the corporation. Like you're willingly signing up for that when you take out a loan with most business lenders. I mean, you have to ask yourself, why would any business lender just say, oh, okay, you have an LLC or a corporation, so yeah, okay, if the business fails, yeah, you don't need to pay it back. No business lender that has been in the business for quite some time is going to do that, to, especially to a startup. Um, in some cases, it happens, but generally these are for very established companies, or if there's a very, very strong, sure source of collateral. So in short, borrowing through an LLC or a corporation, or a web of entities, and you think you're going to trick the system, that's not going to save you, because almost every time you're signing that, they just go directly to you. So you have to keep that in mind. So how much experience do you have in the field that you're starting to launch a business in? Experience greatly reduces the risk of a business failing. Doesn't make the risk go away entirely. Again, things can, external events can come and hurt a business's prospects. For example, COVID. Lots of people with lots of experience started businesses, and then COVID came and their businesses completely tanked, right? Because they weren't allowed to operate their business. They still had to pay their leases. Things can happen. Health problems can happen. So experience will reduce, the risk of your business failing. It won't make it go away entirely. So the more experience, the better. Have you operated businesses like the one that you're about to start? Or have you worked in the industry that you're now launching a business in, or growing the business in? How much do you plan to borrow? The more you borrow, the more risk. Pretty self-explanatory. The higher the interest rate, the more risk. The worse the terms, the more risk, right? So self-explanatory stuff, but need to be said nonetheless. You want to get the best terms possible. Ideally, you borrow as little as you need to, and you bootstrap the rest. If you have a really good business that's just growing and growing and growing, and you're reasonably confident will continue happening, okay, maybe then you start looking at using a little leverage to facilitate further growth. But and then again, you're still taking a risk. So generally you want to just borrow what you need to, but also keep in mind, you also want to have your risk goggles on and think, okay, so how much experience do I have? How much am I borrowing? You want to ask all these questions and then make the decision. Okay, does it make sense to borrow? If anything happens, can I pay it back? You don't want to find yourself in a situation where you're stuck doing that. Stay away from predatory lenders out there. We talked a little bit about pawn shops, right? We talked a little bit about payday lenders. Now, I can't say that all of them are bad. I'm not going to say that, because that would just be kind of like a blanket statement, and it wouldn't be true. But generally speaking, in those pools, I mean, you're going to find maybe some shady characters. I personally, and I'm not speaking on behalf of anybody here, I personally would stay away from pawn shop lenders, payday lenders, lenders of that nature. They're going to make operating your business more difficult than it needs to be. Operating a business is tough enough, so don't get yourself into agreements with, people that are going to make your life more difficult. And again, in those pools, that is where you might end up in that type of situation, relative to other pools of lenders and capital providers. Okay, so that might have sounded very negative, and you might be saying, okay, why did you even come to this access to capital event if you're telling us that, there's all these risks, lots of businesses fail? And again, the answer, it depends. In some cases, it can make sense, and it does make sense. I lend money to businesses all the time, and I don't feel when I do that I'm taking advantage of them or putting them in a bad situation, because we've vetted these businesses. And these businesses have experience, they have clientele, they have experience in the market, and we don't give a loan to a borrower unless we see that their financials can support the terms of the loan. We don't lend more than the business, that based on data and numbers, that it makes sense to lend to that business. But again, some lenders out there will do that. They'll just, if they think they can make a quick buck off a borrower, they might do that. So again, you want to make sure you're being careful. So in a nutshell, to this cold hard truth of borrowing money segment, the more experience you have, the more cash you have, the better your geography, the better the clients, the safer it is, the better the processes you have, for the track record you have. the safer it becomes to borrow money. When you're going to something cold, generally you want to stay away from borrowing before you have processes and systems in place. And most lenders would agree with that. And they wouldn't even make the loan if you didn't have at least some experience or some way to repay them. So now that we've discussed, these less traditional ways to source capital and these cold hard truths about, borrowing money, I'm going to talk about some of the traditional methods of gaining capital that you might want to know about. And some of you may already know of these sources of capital and ways to borrow money, and some of you may not. Again, I'm kind of starting at the ground level and building my way up. So from there, you have a foundation and you can become experts from there. But these are the basics. So maybe one of the most popular business lending categories is unsecured business loans. This type of loan is generally used to finance short-term borrowing needs, not always, but for the most case, that's generally what they're designed for. No collateral is required, so you're not putting up a piece of equipment or a business automobile or commercial real estate or anything like that to get the loan. Therefore, with unsecured business loans, the interest rate is generally higher than with secured business loans, because in the financial world, the more risk that a lender sees, the higher the interest rate they're going to charge, and the lower the risk, the lower the interest rate they're going to charge, all else being equal. The next would be secured business loans. So with a secured business loan, it's generally used to finance longer term needs, such as equipment, real estate, business vehicle. With this type of loan, the borrower pledges collateral, which reduces the risk for the lender. So given that, the interest rate's generally lower than an unsecured loan because there's less risk. Business lines of credit, very popular. Definitely over the past couple of years, I've seen these become more and more popular. So these are similar to business credit cards, but there's some important notes. So, the line is issued under the business's tax ID and name. It's revolving. So, with a business credit card, if you do a cash advance or take cash out, generally you hit with a pretty hefty cash advance fee for pulling cash out. The line of credit, generally you're not charged a cash advance fee. You are charged interest, but it's not that super high cost that a lender would generally charge you if you pulled cash off a credit card. So with a business line of credit, it's good for covering things like payroll, or if you're like an importer in an import-export business, if you need to, buy something from your supplier, maybe your supplier will give you a discount if you make a larger bulk order. And in a lot of cases, businesses can't get to that large, bulk order that they would be able to without the line of credit. The line of credit helps them buy in bulk and save via discounts. It can help with marketing, expansion, things of that nature. So it can be used for lots of different things. And if you're familiar with a home equity line of credit, it's kind of similar to that, except it's generally not secured by a home. It's for business purposes, but you can pull from it, you have the money, pay it back. Once you pay it back, the money is available again, so it's revolving. You use it again and again and again. So that's the nice thing about a business line of credit. And SBA loans, there's lots of interest in SBA loans. And the way that SBA loans generally work is banks and qualified lenders actually make the loans on behalf of the SBA, following the SBA's guidelines and criteria for making the loans. Generally, they have very competitive interest rates. They're backed by the U.S. Small Business Administration, in part, which makes it safer for lenders to make the loans. So it can be easier in some cases to get an SBA loan than another type of loan, because it gives the lender some reassurance that, hey, if something goes wrong, the government's going to come in and help. They're going to protect us up to a certain extent. So lots of small business owners get SBA loans due to the competitive pricing. Sometimes it can be easier to get an SBA loan, so on and so forth. You can go to sba.gov, sba.gov to learn more about the different SBA programs out there. At Wells Fargo, we generally use SBA loans for to help business owners buy commercial real estate to occupy, to help experienced business professionals buy businesses in fields that they have experience in. And then there are other uses for SBA financing as well. That's what we tend to use it for at Wells Fargo. But there are many other things that we do lend SBA money for other needs as well. Those are the two most common uses at Wells Fargo. But again, there are many lenders out there that will make SBA loans for many purposes, equipment, working capital, things like that. Just not as common, I would say. Okay, last but not least, invoice factoring. So invoice factoring is a type of financing that involves selling a business's invoices in exchange for cash. So accounts receivable. The business has lots of money that's owed to it, outstanding invoices. Instead of waiting to get paid and not having cash in the bank account, a bank or a specialty lender might say, "Hey, listen, we'll buy your invoices off you." Generally they're purchased at a discount to what you would get in if you were to wait. But there is a time value to money, so the sooner you receive money, the sooner you can use it to pay for projects that might bring the company more wealth. The sooner you can invest the money, the sooner you can hire employees that might be able to go out and bring in new clients. So there's always a trade-off, and the businesses need to. They're generally their financial managers who are tasked. I'm talking about larger corporations here, but generally like a larger corporation, their financial managers would figure out whether it makes sense to sell the invoices. I mean, if we get the money sooner, will we be able to put it to use to where it can offset the cost of the invoice factoring? That's what the goggles you have to look at any sort of loan arrangement through. Does it make sense to pay for this financing arrangement? What benefits will we get down the road? Can we put the money to better use, and will our return on the money be higher than what we're paying? If not, you're lowering the business's wealth and the wealth of the shareholders. So things to think about. Okay, and last but not least, we're short on time here, so I'll go quick these last few points. Last but not least, equity financing. So we talked about loans, we've talked about lines of credit, we've talked about grants, we've talked about crowdsourcing, we've talked about bootstrapping, we've talked about getting funds from family and friends. But what about equity financing? If you have a business and you could benefit by having a partner, let's say you own a sandwich shop and you have a friend who's also operated sandwich and tea shops or whatever case might be, and they have a successful track record of making these shops very profitable. They have a successful track record of opening locations in new markets and lots of revenue, operating successful operation. You might say to this person, "Listen, I want you to be my business partner. You have such a good track record of this. In exchange for me making you a whatever percent owner, you can get say 30% in my company in exchange for this amount of cash." Well, if you can find a situation like that, your business doesn't have to pay back the money. Your business receives the money in exchange for giving up some ownership. That can get messy, especially if you're bringing on owners who don't have experience in the industry that your business operates in. It can get messy if the person who bought into your company does not have the same personality type as yourself. So there are lots of ways that can go wrong. But there are also lots of ways that could go well. So for example, if the personality types work well together, the person has lots of experience. Generally, you want to bring on partners who have lots of experience doing what you do. They give you they business some cash, they become owners. Now they're incentivized to make that business a success. They share in the profits and losses of the business. So something to think about. It can be a complicated thing. Usually before you do that, you want to speak with your CPA and your lawyer and your financial advisors to make sure it makes sense. But that is another source of capital that I need to speak about here because it's an important one. It's a common one. Business doesn't have to pay it back, generally speaking. Okay, so I've got 6 minutes here. I got two things that I want to cover. Well, one thing, I'm just going to make a little plug here. I'm not going to share my screen and go through all of this with you. But if you go to wellsfargo.com, we do have a section on our site for small business owners. And it goes through our various business lines of credit. There are some resources there for small business owners to help you learn about entrepreneurship and how to operate a business. So take a look at our website, go to the small business section, read through it. Don also noticed you would put my email, my phone number down here. I'm happy to answer any questions that you might have, whether you're here in Long Beach, whether you're in Philadelphia, whether you live in wherever you live, whether you live in Hong Kong, you can call me and I will gladly speak with you. You can just send me an email. So hopefully Don can Don, if you can put my email in the YouTube description, that'd be great. Send me an email and I'd happily speak with you anytime about anything that's on your mind. Okay, so we have 5 minutes left. Don, I do have, I wanted to go over, a few things that lenders look for when deciding whether or not to, make a loan or to provide capital to a business owner. Do you want me to go through that or do you want me to open it up for questions?
You know what, Aaron? I think you can. For those who are joining online, if they're pressed on time, they're more welcome to, sign off. However, I would like to have this on recording. That way when we do upload it, for our community members, they'll be able to learn more about this.
Okay, yeah.
And afterwards, we can open it up for questions.
Okay, wonderful. And I take it most of the questions are probably coming via email at a later date. It's going on YouTube, which is great. So again, if people can reach out to me anytime, or they can reach out to you, Don, and you can connect us. I'd be happy to answer questions.
Yeah, I've added your email address in the chat. So for those who are joining online, you can just go ahead and copy and save that for yourself.
Yeah, I think it's great, Aaron, to share, if somebody applies for a loan, what does the bank look for? What does Wells Fargo look for? And then some of the things that, okay, why was it denied? And maybe, I don't know if you can share that too.
Absolutely. Yeah, and I'll go through that here. This is going to be general information about what pretty much every lender looks at. But some lenders look at more things, some look less things. But generally, the 5 things I'm going to cover here, every lender looks at these 5 things. And this has, some people call these the 5 C's of credit. Some people don't call it that, but there are 5 C's of credit that we're going to talk about, things that lenders look for. So keep these in mind. So the first C of the 5 C's of credit is character. So if someone's lending you money, they want to know what is your character. In the olden days, you might have gone, to someone in a village and said, "Hey, listen, I need this money to buy an ox so it can help me plow my field." And that person might have said, "Hey, well, I don't really know you, and I don't know if you'll be able to pay for the ox. And you're telling me you want to pay for it on payments. So go ahead and find me 3 or 4 other people who have done business with you and who can give you references to prove to me that you have good character and that you'll be able to pay back, make the payments on the ox that I'm selling you." In 2023 and beyond, which it's not done that way anymore, generally speaking. Most lenders will look at your credit report. The 3 main providers of credit reports, your 3 main credit bureaus, Equifax, Experian, and TransUnion, are generally leveraged to pull up data on someone's credit history. So, in a nutshell, do you have a background of borrowing money? And if you do, what has your track record been like? Repaying the debts over time? Do you make your payments on time? Do you carry an excessive amount of debt at any given time? What is your credit score? Scores generally range from between 300 to 850. And, the higher you are on that, the safer you are to a lender. And remember, the higher the risk that a lender sees in you, the higher the interest rate and vice versa. So the lower your score, which signals higher risk, inverse relationship. Lower the score, generally the higher the rate, higher the score, lower the rate, generally speaking, all else being equal. The first C is character. The second C is capacity. So what is your ability to repay the loan? Whether you're an individual trying to get a personal loan or a business aiming to get a business loan for whatever the need may be, a lender is going to be naturally going to want to know how are you going to repay the loan and what are the chances that we're going to get our money back? One of the ways that they measure that is they're going to look at your debt to income ratio. And your debt to income ratio is what are your monthly payments compared to your monthly income. It's one way to look at it. So what are your debt payments compared to your income? The more debt that you have to pay on a monthly basis compared to your income, the less you have to work with, the more that might topple over your financial situation and make you more of a risk to a lender. So different lenders have different requirements. Some lenders want your DTI to be under one number, another lender might want your DTI to be under a different number. Generally speaking, this is just generally speaking here, because again, everyone is a little bit different. But generally speaking, a healthy DTI is like 30% or less. But again, that number can change based on the lender. The safest DTI is you have no debt, and you're getting a loan, you can healthily support it and stay into that 30% mark. But again, the situation will change depending on the lender you go to. So how do you improve that? Well, you either increase your income or you reduce your debt. Don't borrow to buy stuff that you don't need. Be as close to a minimalist as possible. Before you buy something on credit, ask yourself, do I really need this thing? Do I really need it, or do I just want it? Can I buy the same product or the same service elsewhere for less? So, for example, someone might go out and, they might go to, some fancy mall, right? And there's a purse or something there, costs $5,000 because it has a logo of some fancy, some company that everyone likes on the purse. Well, maybe there's a purse that you can get that does the exact same thing. It holds things nicely in it, has a nice look to it. Maybe you can buy a purse for $50 instead of $5,000. And it's just a simplification, but can you, when you're buying things on credit, maybe can you buy something that has the exact same purpose for less money? That's one way to look at it. Forget prestige. Don't try to impress others or keep up with the Joneses. Avoid materialism for the best results. And just know that these days, being normal financially, generally that means, being in debt, valuing material belongings over experiences. So to try to not be, normal in a financial sense, you want to be someone who saves your money, stays out of debt to fuel consumerism and materialism. And if you do need to use debt, you want to reserve those for things that are going to, improve your wealth over time. Using credit to buy things that go down in value, depreciating assets, purses, shoes, phones, whatever the case may be. Over time, those things go down in value. When you use debt, generally you want to use it to buy things that go up in value over time. So just some quick notes there. So stay out of unnecessary debt to keep that down. Capital is the. Go ahead, Don.
Oh, I was going to say, Sandy, who joined online, says this segment deserves its own presentation.
Thank you. I appreciate that. I really appreciate that.
Yeah, I think you saved the best for last. This is what we need to know. I was like, okay, right here.
Okay, great. No, and I'd be happy to come back and speak more about it. But yeah, I mean, so there's that. Capital is the third C. So the first two, character, how are you going to pay it back? Capacity, character, what's your history been like paying back debts? How have you managed credit? Capacity, are you someone who's responsible with credit? Can you pay it back? What does your current situation look like based on your actions in the past? Capital. So, okay, lenders are going to say they're looking at two people. One person has a bunch of cash in the bank. Other person has no cash in the bank. Who's safer, almost being equal? The person with more capital. Now, we're talking here about accessing capital. Maybe someone coming here doesn't have, a lot of money in the bank or whatever the case may be. But just that's the general idea with capital. The more cash and liquid investments you have, things that can quickly be converted to cash, the safer you are, all else being equal. You can use cash for a down payment, use it as collateral for a loan. And to be honest, lenders love lending money to people when they don't really need the money. Now, is that frustrating? Yes, it's frustrating, but people joke about that all the time. It's like, hey, so I had to go through all of this to prove to you that I didn't really need the loan in the first place. Well, I mean, that's a simplification. Okay. I mean, people don't always want to use their cash for whatever they're borrowing it for, but the more you have in the bank when you go apply for the loan, the better. So keep that in mind when you're approaching lenders. If you can show you have some assets, that's going to work in your favor, more than it would if you didn't. So collateral. So the fourth C of credit is collateral. A collateral gives the lender reassurance that they have something there if the loan cannot be repaid. So it makes the loan a safer bet. Some examples of collateral, or when collateral is used, would be business automobiles, equipment, mortgage loans or commercial real estate loans. There's always an asset in the background that the loan is based around. They're going to look at what the value, but what the useful life of that asset will be over time. It's generally going to go down in value over time. So they want to make the length of that loan no longer generally than the useful life of that asset. So that gives the lender some reassurance. Same with capital as well. If you have cash, some people like putting their cash down as collateral for a loan. In some cases, that can make sense, especially if your cash is going to earn some interest. Maybe while it's used as collateral, it can maybe offset the interest you're paying, and people want to keep the cash there for later, for whatever the case may be. Something to keep in mind. Some lenders will also tap people's investment assets. So people might have a brokerage account with investment assets in it. Some lenders will allow that to be used as collateral. So keep that in mind as well. And the last C of credit is conditions. So some things that lenders might consider, thinking about the conditions, how long have you been employed if you're going for a personal loan, or how long you owned the company if you're a business owner. How many years of experience in your field do you have? I mean, we spoke earlier about the risks of being a business owner. With any risk can possibly come great reward, or come something that's not so good. But the more experience you have, the lower that risk is, and the more likely that you're going to do well, which can make you appealing as the recipient of a loan from a lender or a bank. Lenders love lending money to people who have track records of success. They compete for them, they fight for them, because it makes lending fun and profitable. So you want to make yourself the best version of yourself you can be. You want to make your business the best version of itself it can be. So lenders will be competing for you. That's always your goal. You get clients to compete for you. Providers of capital compete for you. You can get there if you do the right things. How is the applicant's industry performing? So for example, think about like the taxi industry. When Uber came along, the taxi industry was naturally hit really hard. It made lending to taxi cab operators a lot riskier than it was the week before, when nobody had even heard of Uber. So there are lots of industries nowadays with the internet that are just being disrupted and made obsolete. So lots of lenders know how to put on those goggles as well. They're disruptor goggles, and say, okay, well, this industry that this business is in, can it easily be disrupted by technology or whatever the case may be? If there's another big virus, how will this business fare? Things of that nature. On that note, what are the prospects for the future, for not only for the business's potential future success, but also for the owner? How many more years will this owner be operating their business? Will there be a transition of ownership from the owner to one of their successors? How might that impact the business's ability to keep paying customers coming through their doors? Right now, there are lots of businesses that are owned by the baby boomer generation that are being passed down to younger generations. It's this huge transfer of wealth and business ownership that's happening now. It's going to be happening for more time, next decade or two, or something like that. If I got my numbers right, but it'll be happening for quite some time. How is that going to impact the business? Lots of businesses are very dependent on their owner. Their owner is the staple of the company. Everybody knows the owner. They want to go to him for whatever service that's provided. When that owner steps down and sells their business to the next owner, a customer is going to want to keep coming through the door. Well, some customers leave. So that's something that lenders consider as well. How's the economy? In a tanking economy, think about the 2008 housing bubble that burst. Everybody was lending money to people to buy real estate. People, if you had a beating heart, and you could sign on a piece of paper, lots of people were given loans that they never should have been given in hindsight, right? But when that bubble burst, lots of people, it became a lot more difficult to borrow for real estate. right? So think about like macroeconomic conditions, microeconomic conditions, what's going on in the economy, and how is that going to impact the purpose of the loan? But is it safe to make the loan given economic conditions? Interest rate. We talked earlier about the risk, right? So if you're a very risky candidate for a loan, and the bank has or the lender has to price you up here, and that's going to make your payments too high and you can't support it, that could kill the deal on the spot. The lender's going to want to know, okay, we have to price them here because we see this much risk in the deal. Will the loan be paid back? Lots of lenders now use data and statistics to figure that out and to figure out the chances of the loan doing well. And there's always a little bit of like the old school, you see in the cowboy movies of a lender just saying, oh, tell me about yourself. All right, I know your cousin, and I know there's a little bit of that too going on with it. So there is, the quantitative side, the qualitative side of figuring out whether or not a loan makes sense to make. Legislative changes. So are there any laws that are, coming out that potentially can make getting the loan or make the business less profitable or hurt the business and hurt its prospects to repay it? What are the prospects of suppliers for the business? Do you have a business that relies heavily on a certain type of supplier? There's a lot of things going on right now with the U.S. importing goods from countries like China, for example, and some people are worried, will we be able to keep buying certain products and goods with these countries that we rely on for imports? So things like that can really, hurt the prospects of a loan. And demand for the business's product. So we talked earlier about obsolescence and disruption. How will there be a need for this business in 5, 10, 15, 20, 30, 40 years? Depending on the length of the loan, that's what the lender is going to want to know. The loans for 5 years, they're going to want to know what the next 5 years look like. The next 10 years, what the next 10 years look like. When someone gives you a loan, they don't technically become your partner in business, but they're going to be thinking like your partner in business. They're going to want to know during the term of that loan, what will the business be looking like? Okay, let me share if I have time, I would like to make a little plug here, if that's okay. Something that do this here.
Yeah, go for it there.
Wonderful, thank you. Okay, can everybody see the screen here that says business lines of credit?
Yes.
Yes.
Perfect. So these are some of our most popular business credit options. I extend these lines to businesses very often. And so do lots of my colleagues. Very popular. There's a huge demand for these lines of credit. This is more of a traditional lending source. So, when you come to Wells Fargo or any bank that offers lines of credit or business loans or whatever the case may be, they're going to want to know about, your credit score, look at the 5 C's of credit, look at the prospects of your industry. It's going to be a full underwriting situation. But to apply for these lines of credit here, we make it pretty easy. You just click on apply now and go from there. But we offer 2 lines of credit in particular I'll talk about. We offer an SBA-backed line of credit called our Small Business Advantage line of credit, which is backed by the U.S. Small Business Administration. It's designed for businesses that have 0 to 2 years in business. So it can be extended to a newer business. In those cases, we are, as we just spoke about, we are going to be thinking about the prospects of that industry, but we're going to be relying heavily on the owner's personal financial situations. Does the owner have a day job that they can use to help repay the loan? Because 0 to 2 years, there might not be any business revenue yet, right? Does what's the household income look like? How much cash or liquid investments does the owner have? For newer businesses, Wells Fargo or any lender, they're going to rely heavily on the individual owner's personal financial situations for obvious reasons, right? Because it's newer. But we do offer a lending product, a revolving lending product, like I spoke about earlier, that can be drawn from, paid back, drawn from, paid back. So it's nice to have. That goes up to $50,000. And then we have our unsecured business line of credit, which is generally designed for businesses 2+ years in business. It goes up to $150,000 as a max. Again, same idea can be drawn from and paid back. Pretty nifty product. It's very helpful. We're a pretty conservative lender, so I'm just talking here about Wells Fargo's lines, but anyone that offers a line of credit, generally it's the same concept. It's revolving. You use it and you pay it back. You use it and you pay it back. Um, as a kind of a rule of thumb, like one of the ways we look at it, again, it's not always perfectly this way, but generally we will consider a line up to about 10% of a business's gross revenue from the prior year. So, for example, if a business did 500,000 just in sales, I'm not talking about net profit. That's also considered as well, of course. Generally, the most we would go up to would be about 50,000, 10% of that gross figure. So something to keep in mind. Every lender is different, but that's generally like our ballpark. It doesn't mean that we will go up to the 10%. It's just generally that would be like the ceiling. Sometimes it's a little higher, sometimes a little, and whatnot. But that's generally the lens that we look at it through. So yeah, on our website, there's lots of resources. I'd recommend going to our website and exploring, and we'd have lots of great things to check out. So let me stop sharing my screen here. And that is it. I know we went over by about 16 minutes, but hopefully that was helpful to everybody. If there are any questions, I'd be happy to take them.
Yeah. Aaron, I want to ask a question. So for those revolving loans, do business have to already have been established for them to apply? And the other question is, like, if somebody's looking for a loan from a bank, should they apply in multiple places, or should they just apply for one and then wait to hear back?
So to answer the first question, they don't have to have been in business to apply. Anybody can apply, but the more experience, the better. We never want to discourage anybody. That first line of credit that I talked about, the small business advantage line of credit, it is designed for businesses with 0 to 2 years of business. So the business has 0 to 2 years and they're credit worthy. They're generally going to be given the small business advantage line of credit through Wells Fargo, again, if they're credit worthy and we decide we want to make the line. The larger line, the one that goes up to 150 potentially, again, based on credit worthiness and financials and all of that. That one generally is designed for businesses with 2+ years in business. As for your second question, just in general, should businesses apply with one lender or apply with multiple lenders? Every time someone applies for credit, it's going to cause a little ding on their credit score, even if they're applying through their business. Again, because those are personal guarantees, generally the application at least, the debt generally won't show up on the personal's credit report. I can't speak for all lenders, but generally it will show up under the businesses. Again, can't speak for everybody. But generally the application will put a ding on the credit report. So I would say the best way to approach that would be to apply with the order of priority, right? So apply first with the lender with the best terms, the one you really want the best. And there are tiers to like business credit. So you've got I guess you can call them like your A-class lenders, like, okay, maybe I'm tooting my own horn, but like the big banks. Generally, they're going to give like the best terms if you can qualify, but generally speaking, they're more difficult to qualify at. Then you're going to have like your second and third tier lenders who, will make loans to. I mean, they're a big part of their business model is they're extending loans to people that can't qualify at big banks. And because of that, they charge more. And then they're like your third and your fourth, and it kind of goes down, like the riskier but more expensive loans. So I would say first you want to see if you can qualify through a traditional lending source if you're interested in credit. And we spoke about those other ways today to get access to capital. Bootstrapping is great. Family and friends could be an option. Grants could be an option. But if you are looking for credit, generally you want to start with the big banks. And you don't want to apply everywhere because again that will hurt your credit score, lower it, which increases your risk, which increases the interest you pay, generally speaking. So that's like in a nutshell the answer. Did I answer that question thoroughly enough?
Yes, you did. Thank you.
Okay. You're welcome.
Very thorough. All right. So yeah, we did run About 19 minutes over. If no one else has any questions, no? Okay, so I'm asking individuals that are in the office right now, joining us in person. Sayan, did you have any final questions?
Um, Aaron, just to go back to the five C's, I think those are so good. I I know this thing is recording, but I was like, I loan some money to people with bad characters, and I see what the banks look at too, right? I'm like, oh man,
Yes,
I kind of knew that already, so now I'm not getting paid back. But the you had also mentioned credit report too, so that's not in with the five C's, huh? I know that the bank probably runs that when people apply for
it
a loan.
is. It is. So, it is part of the five C's, it's part of character. And the analogy that I was making, or I guess the example I was giving earlier, is that like in the olden days or in like private lending arrangements, it sounds like you made some loans to people you knew. You probably didn't look at their, well, maybe you did, but I mean, a lot of people who are making private loans to people, it's usually based on like a handshake deal. Like, oh, okay, you seem like a trustworthy person, or yeah, I've got a couple of references from your friends. That's the way historically through most of history, the way credit has been extended. But now, most lenders you judge character based on the credit bureaus or your credit report. Some lenders also, base it off of like talking to the person. Generally, smaller banks are more likely to be that way. Filling the person out through conversations, maybe references. But I mean, the vast majority of lenders now use, technology and the credit bureaus and credit scores and you know tax returns and things like that. So, well, not tax returns to judge character, but they use that credit report and your score and things of that nature to judge your character in the modern age. But there still is a little bit of the old handshake way to make a deal and just uh, talking to someone and figuring out their goals, and there's a little bit of that still, but it's mostly based on the credit report.
Uh, Sorry, I'm just gonna keep asking a question here. So, Aaron, if is gonna apply for a loan, then would it be advisable if they start to clean up their credit or, put money in the bank just to have some kind of I don't know, a cushion in there? So when the bank sees your whatever your account or your credit report, so then that way it's somewhat fixed. I know they probably look deeper too, but
Yeah, absolutely. So for most business loans and lines, most banks will look at the owner's, personal reports. So it definitely makes a lot of sense to clean up your personal report. Some lenders out there offer something called secured credit cards, which are designed to help people rebuild their credit. I'll talk about that first and other things that can be done. But what a secured credit card does, generally you give the bank a small little pile of cash, $300, $500, whatever the lender offers. Generally, people doing this, they have, no credit history. So, they're a risk to a lender to give them, if it would be too risky for the lender to give an unsecured credit card to someone because they don't know who they are. They might have applied to the internet or responding to a mailer, and that person might just max it out and run away, right? So what the secured credit card does is it gives the bank some security, and it also gives the bank the ability to provide the borrower the tool to prove to the bank, who then reports the actions to the bureaus. Um, it helps, it makes the bank comfortable enough to do that. The borrower will give the banks, again, say $300, $500, $1,000, whatever that lender requires, whatever the minimum is. You can do a lot more than that too if you want. And then the bank will, in exchange, give that person some plastic, a credit card for the exact same amount. I mean, there's no leverage there, obviously, because you just gave them the exact same amount. That's just there like a security deposit. And then you can use that credit card the same way you use any credit card, and the bank feels comfortable because they have the collateral there. And that person who signed up for that, then they would be wise to use the credit card, pay it off in full every month, not carry a balance. Ideally, if they're trying to build their score as high as it can go, and then the bank will report that to the bureaus, and that should help. That's one of the ways that you can increase your score. The best way to increase your credit score is to pay off your credit card in full every month, not carrying a balance. Some people come to me and they say, oh, well, when I used to work with individuals more than not businesses, a lot of people would say, oh, I heard that to build your credit report, your credit score, you want to carry a balance, right? You want to carry that 30%. They get, the wrong information. Generally, you want to be under 30% DTI. But that doesn't mean that you want to carry any balances. The best way to build your credit score up as high as it can go and to help your financial situation the best, if credit's important to you, some people it's not, for religious or cultural or whatever moral reasons, whatever it might be, is to pay off your credit card in full every month. That will help you boost your score as much as it can, and it will help you avoid the penalties and the fees associated with carrying a balance on a credit card. And then other things, this is not my area of expertise, but there are, you can go to, Experian's website, for example, and you can work with them on things that are on your report that might be lowering it. Like there might be, bills on there that were reported that a lot of people have dealt with identity theft over the past few years, especially with COVID. So there might be, like bills or something that report as unpaid, but you didn't actually take out that product or service that's saying that you have an unpaid balance. You can dispute those those balances. It can be kind of a pain to go through that process, but I mean, you can hire some companies to help you with that. Some of those companies are a little bit scammy. So you're gonna want to do your research and make sure you're retaining a company that's quality and isn't just out for your money. But you can contact the bureaus personally and try to work out those things. And if you do have outstanding balances with other banks or lenders, working out ways to pay those off can help you out as well, with cleaning up your record a little bit. The best thing to do, obviously, is if you don't have any credit history at all, is to not use credit to fuel consumerism and materialism and things like that. That's what gets most people into trouble. And to every month pay off your balance, use your credit card like you would a debit card or cash. Don't put more on it than you'd be willing to, pay for cash with. One of the reasons why credit cards are so popular or so common, when people use a credit card, it hurts less when you buy stuff, right? So there's like psychology behind that. If you go to a store and you swipe your credit card, right, it doesn't hurt as much. You're just swiping some plastic. It hurts a lot more when you pull some cash out of your wallet and you count it. Here's $1, $2, $3, $4. So that hurts more, but it's actually good that it hurts. You want to feel that pain. So you want to have a healthy mix. You want to have a good credit score. If you're like most people, so for example, if you live in California like us, it can be near impossible to buy a house with cash, right? In other states, it's more common. So you're probably going to want to have a good credit score, so one day you can buy a house or something like that, right? But you want to stay away from using credit for, like I said, materials and consumerism. So you want to have that healthy balance. You want to big cash, use your debit card for certain things, and maybe use the credit card for a little when you're first starting to build up your credit. Maybe use it for things like to pay your phone bill or your utility bill, things that you're going to pay anyway, and things that that you're going to pay off in full at the end of the month. So that would be my 2 cents on that.
Thank you, Aaron. Everything that you shared today was very insightful. I can see faces here, that there seems like everyone have learned a lot. I know we went over a little bit of time, but it's really great to have, especially on recording, so that everyone else can learn right after this when we do upload it to our YouTube channel. So with that being said, I do just want to let our guests know that, after our webinar, you will be sent out an email. It will be a post survey, pretty much letting us know how Aaron had did with this presentation and all the information that he provided us, letting us know how else we can do better. And one of the questions too is, if you want us to send out you a recording of this webinar, so please go ahead and take that survey for us. Very appreciated much. And I'm just gonna end it with Sandy. She said, loved it. I wish I heard and knew more about this in my teens, so my adulthood would have been easier to navigate. I hope I read the entire thing. And in preparation of entrepreneurship. Yeah,
we've all been there, Sandy.
Well, yeah.
Yeah, it blows my mind that these things aren't taught in school, or just like personal finance, which ties into business finance. It's not taught in school, so you really have to take it upon yourself to learn and to educate yourself and whatnot. Yeah, and it blows my mind it's not taught in school. And I wish we had more time to talk, but I'm glad it was helpful, Sandy. Thank you very much.
Right, right. So yeah, with that being said, also, maybe in the future, Aaron, we can bring you back for maybe we can discuss more on the 5 Cs and going more in depth with that. I think that would be a really great topic to discuss more about.
Absolutely. Just let me know. I'd be happy to come back and speak.
Okay. Well, thanks to our guests for joining today and everyone here. You know, um, Look out for future workshops. I have everyone's email, so for the Raymond, well, just enjoy the rest of your day. Thanks again, Aaron. Thanks again, Sayan, for co-hosting. See you soon.
Thank
Thank you
you.
very much.
Bye,
Have a good one.
guys.
Bye.
Bye.